Swayam Prabha. Digital India. Educated India.
Yogah Karmasu Kaushalam.
Hello students, I, Dr. Dhaval from Gujarat University welcomes you all. Today we are going to cover unit number 1B. Topic is capital, revenue, deferred revenue expenses, reserves, provisions and contingencies. In the previous 5 parts, we have acquired information about fundamentals of accountancy. In continuation, we will now study some accounting terms in detail with justification and illustrations. This covers types of expenses, which includes capital expenses, revenue expenses, deferred revenue expenses, and then we will also discuss the difference between the capital and revenue incomes and expenses. We will cover some practical understanding on capital and revenue transactions as well, and lastly we will cover provisions and reserves with their meanings, objectives, features and importance. Let us commence with the types of expenses. Accounting aims to ascertain and present the 2 types of results of the business for an accounting period: profit on or loss incurred during the respective accounting period. Second is economic status of the business organization on the last day of the accounting period. However, transactions for profit measurement and economic status are different in nature. For measurement of profit or loss, only revenue transactions are considered, and revenue transactions are those which are routine in nature. All revenue transactions are recorded in the profit and loss account or the income statement. These transactions are associated with production and sales, and in the context of the revenue transactions, purchase will be done, expenses pertaining to the production and sales will take place, and finally sales will be made. Once sales are done, the process of purchase will commence again, and this cycle continues. At the end of the accounting period, profit or loss will be ascertained from these transactions. Please keep in mind that revenue transactions are always operation oriented transactions. To check or see the economic status, only capital transactions are considered. Capital transactions are those that are not routine in nature. All capital transactions are recorded in the balance sheet. Liabilities and assets are disclosed in the balance sheet only. The positive difference between assets and liabilities indicates a good economic status, meaning good financial condition, and vice versa is the situation. We have discussed both the types of expenses here, but there is a third category of expense, that is deferred revenue expenses. These expenses are recorded on the asset side of the balance sheet. The benefit of deferred revenue expenses is availed by the business for a period of more than 1 year. These deferred revenue expenses are not real assets, they are known as fictitious assets or the spread expenses. Initially, these expenses are capital in nature. These capital expenses are transferred to the profit and loss account as revenue expenses in the year their benefits are utilized. For example, a debenture discount is transferred to the profit and loss account in proportion to the debenture amount utilized for the respective accounting year. The identification of capital, revenue and deferred revenue expenses has great importance in financial accounting. Inappropriate recording creates misleading financial results for a business unit. Now we will discuss about the capital incomes and expenses. The name itself explains the meaning of capital incomes and expenses. when capital is introduced to commence the business, it is not introduced for 1 or 2 years, but for an indefinite period, because the business will exist for an indefinite period. This introduced capital is known as capital income. Additionally, to increase the amount of investment, loans are taken from banks or financial institutions, or by issuing debentures, which is also capital income. These capital incomes are created for longer periods and are non-recurring incomes. It is obvious that expenses which are capital in nature have a longer period as well. These are non-recurring expenses. Capital expenses contribute to the revenue earning capacity of a business over more than one accounting period. For example, plant and machinery are acquired for business operations with an estimated life of 15 years. Production from these plant and machinery will be utilized for the 15 years. Other examples include land, building and investments. Since capital expenses are for period of more than 1 year, a specific amount is transferred to the profit and loss account each year. This transferred amount is treated as depreciation on fixed tangible assets like buildings, plants, machinery, etc., and amortization on fixed intangible assets like goodwill, patent, trademark, etc. To the extent of the amount of depreciation and amortization, the value of that respective asset is reduced. After deducting such depreciation and amortization from the respective asset, the net amount is disclosed in the balance sheet of that respective year. This net amount of that respective asset will become the opening balance of the next accounting year. The recording place of capital income is on the liability side of the balance sheet and capital expense are on the asset side of the balance sheet. Now we will cover the revenue incomes and expenses. The basic nature of revenue income and expense is reoccurrence. The frequency of reoccurrence of such incomes and expenses may be the weekly, fortnightly, monthly, etc. It can also be the daily as well. These incomes and expenses are associated with operations. Revenue expenses are incurred to generate revenue for a particular accounting period only. Revenue expenses either occur in direct relation to revenue or in relation to accounting periods, such as cost of goods sold, salaries, rent, etc. The cost of goods sold is directly related to sales, whereas rent is related to the particular accounting period. All revenue expenses expire in the same accounting period. Revenue income is the total amount of income generated by the sale of goods or services. Revenue expenses may be in cash or non-cash form. Rent, salary, selling expenses and administrative expenses are examples of cash revenue expenses. Depreciation on fixed tangible assets, amortization of fixed intangible assets and goodwill written off are examples of non-cash revenue expenses. Revenue income can be in the form of rent received, commission received, interest received, dividend received, etc. The difference between revenue income and expenses for an accounting period is either profit or loss, as the case may be. In case of profit, revenue tax is to be paid on such profit. The profit or loss of the profit and loss account is finally transferred to the balance sheet. Now we will discuss about deferred revenue incomes and expenditures. Capital expenses are for a significant long period, generally more than 5 accounting years, while revenue expenses are for 1 accounting year only. Deferred revenue expenses are a mixture of capital and revenue expenses. Some part of deferred revenue expenses is considered as a revenue expense and the remaining part is treated as a capital expense. The next year, some part is again treated as a revenue expenses and the rest remains as capital expenses. This process continues until the entire amount is exhausted. In other words, deferred revenue expense is an expense for which payment has been made or a liability incurred in the current year, but which is carried forward after deducting the share of the current year. The remaining amount is carried forward to the next year because the benefit of the remaining expense will be available in subsequent years. In short, it refers to expenses that are for the time being deferred from being charged against income. Such suspension of charging of operations may be due to the nature of expenses and the benefits expected from them. Deferred revenue expenses should be revenue expenses by nature in the first instance, but its matching with revenue may be deferred considering the benefits to be accrued in the future. Preliminary expenses, debenture discounts, debenture redemption losses, advertisement expense, etc. are the illustrations of the deferred revenue expenses. These are known as spread expenses and fictitious assets as well. There is also a concept of deferred revenue in accounting. Deferred revenue, also known as unearned revenue, refers to the advance payment of a company receives for product or services that are to be delivered or performed in the future. The company that receives the prepayment records the amount as deferred revenue, a liability on its balance sheet. Deferred revenue is a liability because it reflects revenue that hasn't yet been earned and represents products or services that are owed to a customer. It's recognized proportionately as revenue on the income statement as the product or service is delivered over time. After understanding capital, revenue and deferred revenue expenses, let's see the difference between capital and revenue income and expenses. Let us see the differences. The first point of difference is base of identification. In case of capital incomes and expenses, it occurs once for a significant period of time, for example, more than 5 years. Whereas in case of revenue income and expenses, occurring regularly throughout the year. The second point of difference is benefits. In case of capital incomes and expenses, benefits are available till the life of assets or liabilities, whereas in case of revenue incomes and expenses, benefits are available for respecting accounting year only. Third point of difference is recording. Capital incomes and expenses are recorded in the balance sheet only, whereas revenue incomes and expenses are recorded in the P&L account or the income statement. Fourth point of difference is revenue generation. In case of capital incomes and expenses, it helps to generate revenue over more than one accounting period, whereas in case of revenue incomes and expenses, it helps to generate income or revenue in the current period only. Fifth point of difference is depreciation and amortization. Here, it is deducted from tangible and intangible assets respectively, whereas in case of revenue incomes and expenses, it is debited to the P&L account as revenue expenses but as a non-cash revenue expense. Sixth point of difference is duration. Here, in case of capital incomes and expenses, time period depends on the expected life of the respective fixed assets, whereas in case of revenue incomes and expenses, only one accounting year is considered. Next is illustrations of incomes. In case of capital incomes and expenses, issue of shares and debentures, bank loans obtained, sale of assets, etc. Whereas in case of revenue incomes and expenses, proceeds from sales, commission, dividend, interest, rent, etc. are the examples of the revenue incomes and expenses. Next is illustration of expenses. Plant and machine, land, building, furniture, trademark, copyright, goodwill, patent, investments, etc. are the examples of the capital expenses. Whereas salary, rent, office expenses, selling expenses, interest, depreciation, commission, bad debts, amount of goodwill written off, etc. are the examples of the revenue expenses. Next is nature of business. For the manufacturer cum trader of a furniture, plant and machine used for manufacturing are capital expenses. Whereas in case of revenue incomes and expenses, for the manufacturer cum trader of furniture, manufacturing, purchase and sale of furniture is revenue expenses, and revenue income respectively. Last point of difference is improvement, repair expenses. Any improvement expenses that increase the capacity of respective assets are capital expenses, whereas in case of revenue incomes and expenses, repairs and maintenance expenses are regular in nature, thus treated as revenue expenses. Now we will cover practical understanding on capital and revenue transactions. For better understanding of capital and revenue transactions, let us identify capital and revenue incomes and capital and revenue expenses. The first transaction is introduction of capital of rupees 5 lakh in cash. The nature of transaction is capital income and place of recording is liabilities side of the balance sheet, and effect of transaction is capital would increase. Second is issue of share capital. Nature of transaction is capital income. Place of recording will be the liabilities side of balance sheet, and again the effect would be capital would increase. Third transaction is issue of debentures. Nature of transaction will remain same, capital income. Place of recording is liabilities side of the balance sheet, and effect is liabilities would increase. Next is issue of bonds. Nature of transaction is capital income. Place of recording is liabilities side of balance sheet, and effect of the transaction is liabilities would increase. Fifth transaction is loan borrowed. Nature of transaction is capital income. Place of recording is increase in liabilities side of the balance sheet, and effect is liabilities would increase. Next is sale of plant and machines. Nature of transaction is capital income. Place of recording is reduction in respective assets from the asset side of the balance sheet, and effect would be the asset would reduce. Next is sale of investments. Effect is capital income. Place of recording is reduction in respective asset from the asset side of balance sheet, and effect of transaction is asset would reduce. Next is sale of land and building. Capital income, reduction in respective assets from the asset side of balance sheet, and asset would reduce. Next is purchase of any intangible assets like goodwill, patent, trademark, copyrights, intellectual property rights, etc. It is capital expense. It increases in respective asset and disclosed at asset side of the balance sheet, and asset would increase. Next is purchase of any tangible assets like plant and machineries, land and building, investments, etc. Capital expense, increase in respective asset and disclosed at asset side of the balance sheet, and asset would increase. Next transaction is sales revenue, commission received, rent received, interest received, dividend received, etc. Nature of transaction is revenue expense. Place of recording is credit side of the P&L account, and effect is increase in revenue profit or decrease in revenue losses. Next transaction is purchase of materials, wages, inward expenses, royalty paid, salary paid, rent paid, commission paid, interest paid, outward expenses, hire charges, repairs and maintenance, factory expenses, administrative expenses, selling expenses, distribution expenses, etc. The nature of transaction is revenue expenses. Place of recording is debit side of the profit and loss account, and effect is decrease in revenue profit or increase in revenue losses. Next and final transaction is taxation provision, provision for bad debts, depreciation or amortization charges, etc. These all are non-cash expenses. The nature of transaction is revenue expenses. Place of recording is debit side of profit and loss account, and effect is decrease in revenue profit or increase in revenue losses. Students, for further clarity of capital and revenue transactions, let us understand some illustrations. The first transaction is repairing expenses of rupees 1,25,000 are incurred for second hand equipment. Here, expenses are incurred to put the equipment into operation to generate future incomes. Thus, it is a capital expense. It is not spent on existing plant. Second transaction is legal fees paid rupees 15,000 for acquisition of property. Here, this expense is for the acquisition of the property, meaning ownership rights are obtained. Thus, it is a capital expense. Next transaction is repairing and whitewash expenses of rupees 22,000 are incurred first time on purchase of an old building. Here it is a capital expense because the building is acquired and whatever expenses are done to put the asset into operation or working condition are capital expenses. Next transaction is rupees 25,000 paid for obtaining license to commence business of restaurant. Here, license fees paid to commence the business is a capital expense. Next transaction is rupees 37,000 are spent on some parts of machine to enhance production efficiency. Here, amount is spent to enhance production capacity. This is an expense on the improvement of fixed assets. The capacity of the business would increase, thus it is a capital expense. Next is rupees 1,20,000 on foreign visit of manager for purchase of special plant. It is not a routine travelling expense. It is for the acquisition of an asset. Thus, it is a capital expense. Next is rupees 45,000 received for trade receivables. Here, amount received for trade receivables means cash collection from debtors. It is revenue income. Next is rupees 1,22,000 on demolition of old building for construction of new building. This expense is necessary to construct a new building in the same place. Thus, it is a capital expense. Next is insurance company paid claim of rupees 1,000 for machine which destroyed fire. The machine is a capital expense and the amount received for it is a capital income. Last transaction is wages paid for installation of new machine rupees 14,500. It pertains to the new machine. Thus, it is a capital expense. Friends, now second point of this module is about difference between provisions and reserves. Before proceeding to the difference, first we will see what is provision and reserves. Provision and reserves are two important terms and components of financial accounting. Provisions help to provide protection and safety to the business against future needs, while reserves helps to strengthen the financial position of the business and can be utilized in any adverse situation. Let us understand provisions and reserves from the viewpoint of accounting. When business is commenced, at that time businessman is optimistic that business will run for indefinite period of time. The life of the business cannot be estimated. Accounting believes that the life of any commenced business is indefinite. Thus, in accounting, one concept developed and implemented. That concept is known as going concern concept. Accounts of a business are prepared by following the going concern concept, that is, assuming that the business will continue for a foreseeable future and there is no intention to close down or scale down its operations significantly. Hence, to determine the net profit for each year, not only the current contingencies but future contingencies should also be considered. In fact, provisions and reserves are such considerations which actually relate to the future needs for which a part of the current earning is kept aside. In accounting, both components have their separate existence and utility. Let us understand them. Meaning of provision. A provision helps to provide protection and safety to the business against future needs. A provision is an amount set aside from the profit and loss account or the statement of profit and loss in case of corporate form of business to provide for a known liability, the amount of which cannot be determined with accuracy. Provision is a financial arrangement made from the profit and loss account only. It is charged to the profit and loss account on the basis of the best estimation. In other words, a provision is a charge against profit for the purpose of providing for any liability or loss. Provision for depreciation, provision for doubtful debts, provision for repairs, taxation provision, etc. are best illustrations of the provisions. For example, taxation provision is provided for rupees 1,20,000, but its payable amount will be finalized by the income tax authorities. It may be more than or less than estimated amount provided. Provisions and liabilities are different issues in accounting. Provision differs from liability to the extent that provision is an estimated amount while liability is a determined amount. Provisions are set aside from the profit and loss account, meaning their emergence is from profit and loss account only, and they are made every year to cover yearly estimated expenses or payments. Liabilities may be current or non-current as per the needs of the business. The sources of liabilities are credit purchases of goods or assets of borrowing funds. For example, goods purchased on credit for rupees 55,000, wages payable of rupees 50,000 for March, or a loan borrowed of rupees 1 lakh for 5 years are liabilities. Thus, a provision is an estimated amount kept aside to meet an uncertain loss or expenses in the future. A liability discloses the amount for which benefits are taken by the business and the amount is yet to be paid. Now we will see the concept of provision. Accrual assumption is a fundamental accounting assumption. In accounting, according to the accrual assumption, all liabilities, losses and expenses, whether determined or not, should be accounted for in the books of accounts to determine the profit or loss for the accounting period. For example, credit sales creates debtors, and when debtors do not pay their amount in full, the unpaid amount is treated as bad debts, which are losses to the business. According to the matching concept of accounting, revenue expenses of the respective year shall be set off against revenue income of the same accounting year. For instance, sale of rupees 5 lakh made in March 2024 with a credit period of 2 months will have a collection received at the end of May. As per the past experience, bad debt takes place at 2% of the sales. Thus, a bad debt provision of rupees 10,000, which is 5 lakh, 2% of rupees 5 lakh, shall be provided in 2023-24. If bad debt occur, they will be set off against this provision, and the profit of 2024 and 25 will not be affected. If no bad debts occur, the amount will be carried forward to the next year. Next point of discussion is objectives of provision. The objectives of provision in accounting are to account for all expenses and losses. When the amounts of liabilities, expenses and losses are not ascertained or determined, they are estimated and accounted for by making a provision from the profit and loss account. As a result of the provision, the correct or near to correct profit or loss is ascertained, and liabilities and assets can be shown at correct values. Accounts must disclose a true and fair position, and thus provisions are created for made from the profit of the current year only. Now we will see the features of provisions. The very first feature of provision is specific purpose. The amount is to be utilized for a specific purpose like depreciation provision, taxation provision, etc. Next is source. The source of provisions is the profit and loss account only. The required amount is transferred to the respective provision account from profit and loss account. The next is duration. Provisions are made for every accounting year. Thus, their time period is maximum of 1 year only. Next feature is uncertain amount. The amount kept aside for provision cannot be accurately estimated. The provided amount is uncertain and may be near to the required amount but not accurate. The next is different utility. It can be provided for anticipated loss, depreciation or known liability that will arise in the future. Now we will see the importance of provision. The first point is true profit or loss of current year. Provisions are made for transactions incorporated in the books of accounts to arrive at the true position of the profit and loss account, helping to disclose the true profit and loss of the business. Second is no adverse effect on operating performance of next year. Provisions deals with the anticipated loss and or expenses of current year, and these provisions are made against profit of the current year only. It might take place during the next accounting year. If any such loss or expense of previous year take place in current year, will be set off against provisions provided for the previous year. Thus, operating performance of current year will be not in an adversely affected. The next is follow conservative concept. Provision is made following the conservatism concept of accounting, which holds provide for all anticipated expenses and losses but do not provide for the anticipated incomes. By making a provision, a part of the profit and corresponding assets are retained which otherwise could have been distributed as profits. Next is maintaining capital. Any loss or depletion in the value of asset or liability not provided against income or profit would effectively erode the capital of a business. Creation of provisions is an attempt to maintain the capital of the business intact. In brief, provisions are provided from the profits of the current year to meet the anticipated losses, expenses or liabilities of the current year. Due to the provisions, the profit and loss account of the next year is not affected and accounts of the current year will disclose a true and fair view of accounts. Now let us understand the concept of reserves. Reserves. In normal terms, a reserve is savings kept aside from the earnings of the current year. There is a positive relation between reserves and financial soundness. Higher reserves indicates better solvency for the business and vice versa. Meaning and concept of reserve. Businesses operate based on the going concern concept, which assumes that a business will continue to operate indefinitely. Since the future is always uncertain, it is necessary to make legal, appropriate and desirable arrangements to meet potential uncertainties or contingencies. In accounting, reserves are accumulated from annual profits to enhance the financial position of the business. Reserves are amounts set aside out of profit or accumulated profit provided for known and unknown contingencies that may arise in the future. Example include general reserve, capital reserve and specific reserve. The provision of reserve does not work in isolation. It is desirable to invest in profitable opportunities and to be sold as and when funds are needed. General reserve, workman compensation reserve and investment fluctuation reserve being appropriation of profit are not shown in the profit and loss account. Features of reserve. The very first feature is purpose. Why reserves are created. Reserves serve multiple purposes such as the expansion and diversification of the company, payment of liabilities, purchasing fixed assets, reduction of debentures, payment of dividends and writing of losses. Second is source. The source of reserve is the profit and loss account or P&L appropriation account. The required amount is transferred to the respective reserve account from these accounts. Third is duration. Reserves may be raised every accounting year and accumulated over time. They can be used for specific purposes as needed and their duration is typically long. Next is amount of appropriation. The amount set aside for provisions is uncertain, but reserve can be mandatory with fixed percentages such as statutory reserves. Other reserves are decided by the management based on need which may be certain such as redeeming debentures. For example, every year 10% debentures are to be redeemed from total debentures of rupees 10 lakh. Here redeemable amount is fixed and that is 10% of 10 lakh, that is rupees 1 lakh only. Next is financial solvency. Accumulated reserves, especially free reserves, belong to equity shareholders. Adding reserves to capital enhances the company's financial condition. Next is legal provisions. Some reserves such as the debenture redemption reserve are required under the Companies Act and the income tax law as well, ensuring funds are available for future needs. Types of reserves. To have a better understanding of the nature and purposes of reserves, let us classify them into different types. Reserves are generally classified into revenue reserves and capital reserves. First is revenue reserves. The main source of revenue reserve is from revenue surplus and revenue surplus is profit of P&L account. It is free reserve and can be utilized for distribution of dividend. Revenue reserves can further classified into general reserve and specific reserve. General reserve is the amount kept aside from revenue profits and not having any specific purpose. It is available for any future contingencies or expansion of business. Such reserve strengthens the financial position of the business. The example is general reserve. Second is specific reserve. Specific reserve is that reserve which is kept aside out of profit for a specific purpose and can be utilized only for that purpose only. For example, workman compensation fund is a specific reserve because it is maintained to pay compensation to the workman only. Debenture redemption reserve capital reduction reserve, investment fluctuation reserve, etc. are the examples of the specific reserves. Both general reserve and specific reserves are not charged against income but are appropriation of profit. Both items of P&L appropriation account, not of P&L account. The second type is capital reserve. The source of this reserve is not P&L account, its creation is either from the profit on reduction of liabilities or profit on sale of the assets. The example is debenture of rupees 10 lakh purchased from open market for rupees 9 lakh 50,000. Here 50,000 is capital profit, so it is capital reserve. Second is an asset has book value of rupees 5 lakh and sold for rupees 6 lakh 50,000. The excess amount, which is 1 lakh 50,000, is profit and it is known as the capital reserve. Capital profits and are normally not available for distribution as dividend. In other words, reserves created out of capital profits and which is not readily available for distribution as dividend amongst the shareholder is called capital reserve. Example of capital reserves are profit prior to incorporation, premium on issue of shares or debentures, profit on reduction of debentures, profit on forfeiture of share, profit on sale of fixed asset, capital reduction reserve, and profit on revaluation of fixed assets and liabilities. All capital profit should therefore be regarded as capital reserves. Capital reserves may or may not involve any receipt of cash. For example, profit on reduction of debenture, capital reduction reserve, etc. are the examples. Now let us recollect the discussion of this part. In this part, we have discussed about types of account, where we have discussed on capital and revenue and deferred revenue and expenses, understanding of types of account with illustrations, difference between capital income and expenses versus the revenue incomes and expenses, and then practical understanding on capital and revenue transactions, provisions and reserves, their meaning, objectives, features and importance. In next part, we will discuss about some remaining issues pertaining to the difference between revenue reserve and capital reserve, secret reserves, difference between reserve and provisions, and contingent assets and liabilities. Thank you. I hope you have enjoyed the session.